Lloyd agrees with me. Dollar strength is there and should continue. That's kind of the good news, because if you're trading, and of course, you said a lot of other really interesting things that I hope you took close note of. But here's the very first part's the one I want to zero in on with you today, because I feel like this is something that needs that you need to be aware of in the next week and next month, and then maybe thereafter. We shall see. But the dollar strength is connected to something is connected to something that might be really big in the markets right now. Okay. The U.S. stock market has been struggling lately, just in the past, couple of weeks, and struggling so much so that it's noticeable. I'm going to share my screen here, and these are trading view charts I'm going to be using, so hopefully that's not too much a problem for anybody, but let's get that up, and there we go. So this is a chart of the VIX and the S&P 500, okay? It might look a little confusing, but hang in there. I'll explain it to you as I go. All right, so the S&P 500 is the purple line, the skinny purple line in here, okay? The orange line is the futures of the VIX, about a month to 6 weeks out. It tracks closely with the VIX and sometimes tends to lag behind the VIX. But in this case, I thought it would be a little more useful to show than just the VIX itself. If you don't know what the VIX is, the volatility index, this is the amount of money that options are being priced above sort of the regular price of, as if a stock weren't going to move at all. This is how much the option market makers think stocks are going to move in general. And options tend to move down. Stock prices tend to move down faster than they move up. So when the VIX starts to rise, it usually means that option market makers are expecting the prices of stocks to go down in the near future, and anytime they go down, the VIX goes up, and until the VIX kind of turns around and starts going the other way, stock prices will more than likely continue to go down. So that's how you read it. It's completely the opposite of the VIX, kind of a mirror index. And you can see that here because the purple line and the orange line are just sort of moving in opposite directions all the time, right? Now the black line is an ETF called the short VIX futures. And so it's the VIX short, literally the VIX upside down. Now the VIX upside down should track right along with the S&P 500. And as you can see, for the most part, it does, right? Anytime it doesn't, anytime it starts to diverge and show variation from the S&P 500, we want to know. We want to know that because that's oftentimes a signal of what's likely to happen with the S&P 500. So if in fact, we'll see, here's an example. Right here in the 1st of February, earlier this year, see how the black line started to pull down and away from where the purple line is, right? And this is a little bit of a, heads up warning, hey, this thing could keep going down, right? And there's this one part here where it jumps up for a bit, And so it kind of gets ahead. I mean, the turnaround is coming, but not imminently, right? And then it drops hard, and then the turnaround comes. Here we are. It's not been forecasting lately, huge divergence, just a little bit of a divergence. It went up, and now, it's kind of catching up. So this makes it look like, hey, maybe stocks will kind of hang in there. All right. Now, how are U.S. stocks and the U.S. dollar related? Well, during this time of year, August and September, there isn't really a lot of big news for the, if you just look at Forex Factory, here's the next week, right? And I just limited it to, orange and red, but a lot more high impact events. And if you read down this list, you can see that, most of them are not huge dollar movers. We've got, consumer sentiment. We've got the Jackson Hole Symposium, which is kind of everybody's financial vacation in the high-end finance world. The Fed guys are there and so forth. And Jackson Hole is a place in Wyoming which it takes a little while to get to. For normal people, these guys, they fly in with the Learjet and they get there, but even then, it's, they got to get to some place, get on that plane, and then they got to get here, and it's not like an all day travel for them, but it usually is a day. They're not going to travel the same day that they have to speak or something, right? So it kind of disrupts their week, and they don't plan a lot of other stuff around that. And as a result, the market, the U.S. market tends to sort of flounder coming into this event by just like, we don't quite know what, maybe they're going to say something, maybe not, and it doesn't usually end up being something of high impact. That being said, people were intensely focused on it last year after, a huge downward market in the U.S. and they're looking to the Fed for some sort of, hint on what are they going to do with interest rates. I mean, because they started raising interest rates last year. Everybody knew they were going to do that, but were they done? And right now, are they done again? Because people have the idea that interest rates in the dollar are going to sort of top out, and they're not going to have to raise interest rates anymore, right? This year, in the Jackson Hole Symposium later at the end of next week, then they're going to be looking for, could that be maybe they're not done. Maybe they're not going to hike heavy, but maybe they're just going to trickle up a little bit, right? To keep raising interest rates. Why would they do that? The inflation information, the news about inflation has been pretty good. Hey, we've got good CPI numbers. It looks like inflation's tapering off. No need to keep with the rates, right? Well, there's a good debate out there on an article on Forex. It's actually from ETF Trends, which you link to it from Forex Factory. It's called The Disinflation Junkies versus the Inflation Revivalists. And if you're the kind of person who likes to dig into the sort of fundamental and background, I would recommend this article off of etftrends.com. In fact, I think I'll just share that in the link there in the chat. There you go. And it makes for a good discussion. I mean, it doesn't say anything terribly conclusively. It's like, well, this could, maybe that could. And in here, the question on investors' mind is why is the U.S. market stuck in the doldrums if everybody thinks we're done raising rates, right? Perhaps the answer lies in the question surrounding who is going to buy all of the U.S. treasuries being issued the remainder of the year, or how consumers and businesses are going to cope with increasing interest payments combined with the prospect of a more subdued labor market, right? So these are kind of the questions this article tries to tackle, but I think that's a very good thing for them to sort of point out the question, right? Who's going to buy the bonds, the U.S. Treasuries? Because that, if the Treasuries can't sell, if the U.S. can't sell its bonds, or the Fed can't sell the bonds off its balance sheet, then they're going to have to lower the price in order to be able to attract more buyers. Lower bond prices means higher interest rates. If you have higher interest rates, then you have dollar strength. And so what I'm forecasting here by looking at these charts is increased dollar strength, which also means increased interest rates. So if we look here at the dollar, the daily chart, Lloyd had that nice big weekly chart, and he's like, for the next 4 weeks, it'll probably trend higher. Yeah, I would agree with him. Not only from a technical standpoint, we've got this sort of, lower highs trend happening here, which we've kind of broken, depending on how you want to draw this. Like if we go from here and then raise that up, that looks a little more like the chart we were seeing with Lloyd going from there. But you see how important, picking the starting point is. I tend to want to pick that one because it's the first new high on this. I could pick that one, but then that's really more like this trend, right? But then the problem is when we get that trend, right? So what do? Well, you sort of like go from, instead of the peak there, go from the close, and that matches that. And then this is close enough in there. And you can see here, from that point of view, we have just barely crossed. And the fact that we cross is not hugely predictive, but it's more like just a line in the sand as a marker for us to say, how different is it? Has something changed in a big way? That's what we're looking for. If in fact we say the market has changed its attitude about, in this case, the US dollar, then that's information we want to take in. That's going to help us with the forecast. If in fact it's changed, it goes along with Lloyd's forecast that, hey, for the next 4 weeks, we're likely to continue trending higher. We have yet to make new highs, seriously new highs, right? Or new lows. So default, we are in a downward trend. How could Lloyd or I say, well, the trend has changed for sure. We are more likely to be going up than down. Unless we saw some sort of, continuing evidence. Well, in my particular corner of the world, the evidence is the stock market. The U.S. stock market has been, there we go. This is the S&P 500 on top, the yen, and the euro. So here's the S&P 500, and we look here from July 27th. See how on July 27th you have this large bearish engulfing bar that from that point the market has just trended down, and it's trended down enough that it's significant. We haven't had, let's see the price range. We haven't had a move quite like this for a little while. So we're down 5.65% from the top of that one candle. So we were the low. It actually closed right there. So not quite 5%. That's how much the move has been. That's not a terrible harbinger. It's 5% drawback. But we haven't had one of these for a while, and you've got to look back into this area here, February, from the last time that we had that big of a move. And right there, that one was a little bit bigger, about 7.5% before it bottomed out and came back up, right? So what happened back then? What happened in February? And was there any way we could know, hey, this got done in about 6 weeks? It'd be a great time to have known and said, let's be a buyer right here, right? Well, you can see that it came down not quite to the same level as where it had before, did not, make the old low, and then turn around and start going back up. So that's a pretty good indicator that, hey, maybe we're going to get because what is a trend? It's higher highs and higher lows. Well, if in fact that low was a higher low and it didn't keep going, then that would be the very beginning, very earliest evidence of a new upward trend. Well, where are we now? We have not yet made the old low, as you can see. So if just this Friday, if that's the turnaround and we start going back up, great. U.S. markets will continue to keep going up, and that's it. That was the bottom of the trend. Now's a great time to be a buyer, and that would, if stocks are going up, then in this case here, it's probably going to be the case that the dollar is going to be going down. Why do I say that? Well, look here. From July 27th, right here, this is the point where stocks topped out. And what has the dollar versus the yen been doing? It's been going up. And what did the euro do during the same period of time? The opposite, going down. So right now, U.S. stocks are doing the opposite of the yen and the same as the euro, right? That's the pattern. So if U.S. stocks change a pattern, if they bottom out and start going up, well, we can expect to see the euro go up and the yen go down. And they're all connected to the expectation of interest rates. Now, why do I think then that this is not a bottom? That, we are maybe going to go up, but we'll probably come down, hit this low, and keep going a little bit lower, right? Well, I don't know for certain, but the reason I'm watching out for that, the reason I'm a little worried as a stock market buyer, right? Most of the time I want to buy the U.S. market, but I'm short term, so I keep my options out there, so to speak. It's back to this. You see this line here where the VIX is trending higher. We got higher lows and we got higher highs right now. That is corresponding to a trend of downward prices on both the S&P 500 and the SVIX, right? So these things moving together make me think that hey, we're not done yet. We could likely see some low. And then last of all, I want to point out this guy who I follow. Now there's a gentleman by the name of Michael A. Gayed, right? And he is not shy about getting out there and saying things loudly when he feels like there's something to be said. And right now, he feels like there's something to be said. Let me get to his latest post that looks like he's really active right now. Here we are. Okay, so this is him right here, this guy, Michael Gayed. Now, he, I met him several years ago when I was working in New York for the CMT Association. He had just published a book and he wanted us to become familiar with it and so forth. I had just published a book the year before, and what I thought was really fascinating was that he had done some research. It was a deeper dive on a very similar topic to the book that I had published, or one of the chapters in that book, and that was about the use of the utilities index and compared to the Dow index, and how you could get information about that. That was kind of one of his main pillars. He and I had not collaborated. He didn't read my stuff when he wrote his. His came out a year after, but we were on the same wavelength. It was the same idea. And so it was really fun for me because his stuff confirmed what I had come up with a year earlier. And he wrote a Dow paper and I did not. And so he won the Dow Award for that paper, but he's won the Dow Award for several papers. And anyway, he says he's kind of concerned right now. He feels like there is a credit event coming. Yeah, there it is. A credit event is coming. It's the reverse carry trade. So you guys know the carry trade is the U.S. Versus lower performing currencies, most particularly the yen, right? A lot of people are buying the dollar yen. The reverse carry trade would be the opposite, right? And he says it's not the butterfly, it's Mothra. I will not relent. September. And then he links to this article here. And this article is from Bank of America, Hartnett, saying that China's data was shocking and warned of a credit event that would crash markets and require a coordinated response. March 2020 was human history's largest coordinated central bank response, and the drawdown was 30%. So he's looking at the S&P 500 dropping down huge, right? Now, if in fact stocks drop really fast, one of the things that kind of helps cause that is people pulling their cash out. When people pull their money out of stocks and they put it into cash, right, that creates demand for dollars and makes the dollar go up. So you would think that, hey, if the market's going down, then people are scared and interest rates are going to get cut. And so the US dollar is going to drop, right? Because interest rates are going to have to go down and coordinated response. Well, in 2008, when it was a serious credit event, everything went down except the US dollar, which was weird because, wow, the US economy is struggling. Why does everybody want to get in the dollar? It's because they're pulling their money out of all of the other assets and repatriating it back to the dollar. So in a very serious economic problem, what happens is that it's flight to safety. You've heard that, right? You've heard that phrase. Flight to safety means money runs back to its home currency. And if there's so much of it that is in the US dollar, that a lot of it comes back to the dollar. So if in fact that kind of thing happens, then we could see the dollar continue to go up. Now he's talking about the reverse carry trade. The reverse carry trade would actually be money coming out of the dollar and, get people, it'd be the dollar yen anyway, I should say. The dollar yen turning around and going down because they're getting out of that trade. They're getting into that trade now, which is pushing it higher. But it's quite possible that even with the credit event, that could continue to go up. But he expects the credit event to be the end of the bear market that we are in. So all of this upward move we've had in the U.S. stocks, it's just kind of coming along for a little while, and then it's going to drop down. Credit event, the bottom of it, that's really going to be the time to buy. And it's very possible that the end of the credit event will occur when you see the yen, the dollar yen, maybe turn and start going down. Well, we'll see. If the stock market starts going down hard and the U.S. The dollar yen goes right with it at the same time, okay, then that might not be the same indicator. But see, we've already seen the U.S. market start to go down and the dollar yen go up, right? That's that repatriating we're talking about. Will that continue? I'm saying we probably will see it continue in a sort of mild manner for the next 2 or 3 weeks. If in fact what he's saying is right, this major credit event, China, Evergrande, all that sort of stuff, if things are really going to get bad in China, then and if that's going to spill over to the rest of the world, then we'll probably see that happen in the next 2 or 3 weeks, and we'll see a dramatic move in currencies. So keep an eye out and keep prepared for that. Daryl, hey, sorry it took me long to get your question. The 2-year treasury is going down. Will that be an indication there could be an indication the US dollar may follow too? Well, actually, the 2-year treasury, let's see, I've got that layout here. There it is. So this is a weekly chart, so really long, slow kind of move, right? This is the inverted yield curve. This is the 2-year compared to the 10-year. And this is one of the reasons Michael thinks that the credit event is inevitable and that it's going to be serious and bad. And a lot of people have been kind of pointing to this, that the yield curve that we are looking at now is so much worse. All of these, led to a market recession. Every time it got below here, below this red line, what followed was a serious recession in the U.S. That being said, I got to say, this one here is really ugly looking, and the recession, it was there, but it wasn't huge. It was just sort of an annoyance for people in the U.S. I remember I was a young father and husband and looking to buy my first house, and it was very difficult to do. But, life went on. I had a job, gas prices, we put up with them, so to speak. It was just kind of an annoyance more than anything. Here in 2000, that brought on the recession in 2001, 2002. That was a lot more disruptive. And yet it wasn't bigger and deeper, maybe a little bit than that one. And then came this thing. Just the inversion of the yield curve was tiny, but yet the recession that followed after 2008 was gigantic, was hugely disruptive, and required a coordinated response between central banks around the world. So just the fact that it crosses is kind of the important thing to watch out for. How deep or how far or how long it lasts may not necessarily matter. And yet this is really deep, and it is going to last a lot longer than these do. And so people are looking at this like, wow, what's coming must be enormous. Well, I mean, not necessarily, right? This was the worst one here in the past 30, 40 years. And like it was almost a so what event, right? So I don't know that we have to have a huge, horrible credit event, a huge, horrible bear market and so forth, just because this is moving down. That being said, when is it going to turn around and start moving up, right? So you talk about the 2-year treasury going down. That's kind of a good thing, but how much is it going down, right? Because it needs to go down enough that the 10-year can get ahead of it, and this thing starts turning around and going back up before we really even care. And so far, that little blip right there, that's the 2-year treasury going down, because the 10-year, this is the 10-year minus the 2-year, right? So if it starts going down, then that leaves more room for the 10-year to push this line higher. But as you can see, that really hasn't made a huge difference in this look. Now, it is a weekly chart, but so my point would be the treasury is going down, and that could be an indication that the U.S. dollar might follow. If in fact this does not continue moving higher, what that would mean is that not only is the 10-year or the 2-year going down, but the 10-year is going down as well, right? And in which case, then this just keeps getting deeper and deeper, and that would be the indication you're talking about. Let's see. I do agree the overall fundamentals we cover next year, U.S. presidential election, will Democrat try their very best to ensure the market won't tank so drastically. Actually, I wouldn't bank on that. It's a weird thing, but my belief is that the Democrat Party likes to use a falling market as a sort of crisis moment, because they campaign on we're going to solve your crisis, right? And like you look at 2008, right? That presidential election, huge downward market right in front of the election. Now, it was a Republican president, so you could say, yes, well, they were banking on that. It's true, but the 2012 election, Barack Obama and Mitt Romney, it was working its way back up and it was kind of starting to go down, and they were kind of banking on, look, see, it's going down. You got to keep us in order to fix it, right? And then Trump was on the verge of being reelected, and market starts going down. It's like, oh, don't let Trump in. He'll mess things up, And then 2020, it was all COVID. Nobody looked past the COVID data point, and but we'll fix COVID, so vote for us. So it's kind of a weird thing. Their campaign strategy is always, you see that problem, we'll fix that problem. That's a very basic level. So I don't know that they are so afraid of the U.S. markets going down. But let's follow your line of reasoning for a quick second. What if the Democrats are like, well, we can't let the market go down. We've got to somehow prop the market up so that it doesn't look bad for us, so that we won't lose the election to the Republicans, right? Okay, if in fact they were going to conspiratorially buy up stocks or somehow keep the market pressured going up because they didn't want to avoid looking bad. Well, as of right now, it's too early by most people's estimations to have to worry about it or care about it. We are in a third election, a sort of pre-election year. And of the four in the election cycle, this year tends to be the best. During the election cycle, the market will go up for a little bit, but then tend to go down. So it's really an interesting thing for Mr. Gayed to be saying huge bear market right at a time when historically, seasonally, for the next 6 months, we should be in great shape. We should be seeing a not huge, but a very strong upward trend in the U.S. stocks. What he's talking about is the opposite of that. Now, it could be that he's saying, yeah, there's going to be something bad, but it's going to be very short-lived, and then it'll be a good time to buy. I could get behind that. I would say that's very realistic if in fact that comes along. But it would be highly unusual for something really bad to come along that threw the market into another year's worth of downward move starting in this September. And yet that's kind of what he seems to be saying. A credit event like that. I'm not seeing it in the VIX. I'm just seeing tiny, small movements there. And so I think it's more like this huge credit event is just going to be papered over real quick. We're going to get past it. We're going to see the markets get nervous until it happens, or some news about it happens, and then it'll pick up and get going better, right? But the bigger question, if in fact Swee's talking about this idea that could Democrats push it higher, or Democrat friendlies push the market higher all the way into the election cycle? They could. But if they were, how would we get a sense that they were going to keep that happening? I think that what you would notice is that around February of next year, February of 2024, that's the time when the markets should sort of peak and sort of kind of drift a little lower. And if it doesn't, If in fact it just keeps pushing, every time it gets low, it finds some support and keeps moving up. Well, that's not conclusive proof. That'd be the first little bit of evidence of of this kind of Democrats propping up the market conspiratorially. And then if in fact that were true, it would sort of hold support all the way until the election. If the Democrats win or lose the election, either way, if the Democrats have been propping it up, or Democrat friendlies have been propping it up, then in November you would see it would drop, because the people are like, okay, we put all that money at risk. Let's hurry and get it out of there, because we know how bad things are, and now that we've already elected, we can let it fall, right? And so then that would be the big move. But I think that's all going to be a lot closer in time to the election, which is of course 2024. So anyway. I guess that's what I would say. Now we've got to move along here, because we've got another course about to start. So let me wrap this up with just saying, hey, there's lots of big, scary things that could happen. But generally speaking, while people are sort of waiting for them to happen, I think you see dollar strength. I think you see this line. Watch this line. And notice, does it drop back under the line and come back down, or does it sort of kind of hold this line and go and tend to go back up, as Lloyd forecasts that it will? If it does, then what you've got are continuing dollar yen trend and a continuing downward trend on the euro. And those are some trading ideas that you can probably work with. So until next time, everyone.